the goal that you're trying to get
Yeah.
to with your, and that's to me, I think.
Location fits into it. So the long and the short of it is.
Absolutely. How about at the end of the day, do you do anything? Like, I'm really fascinated by rituals and things like that.
So I think it's really important to be ethical and make sure you're paying them well above.
Renovators is that, when you look at a property perspective, it's your home.
Hi, I'm Owen from Rask Australia. Thanks for tuning in to the Rask Network. Before we get into today's show, there are a few things we have to go over. Firstly, what you're about to hear and see is limited to general information only. It's not personal financial advice like you get from a financial planner. Also, it's important to remember that past performance is not indicative of future performance. That means that anything that's happened in the past, or we say today, is not necessarily going to reflect what happens in the future. Lastly, please consider that any of the guests or myself are featuring on this program may have a financial interest in some of the products or shares mentioned. That's enough from me. I hope you enjoyed today's program. Good evening, everyone, and welcome to this very special Rask Live. My name is Owen Rask, and it is my pleasure to have you with me this Thursday night. I can see many of you got into the chat early tonight and have already started commenting. Owen Boxall says, have to buy international or US funds to balance my retirement portfolio. Can't decide between IOO or IVV. Can't give you personal advice, of course, Owen. But IOO does have fees of around about 0.4%, and IVV is 0.04, so 1/10 of the fees. But I think it depends on the exposure too, right? There's a lot of difference between the IOO ETF. Good question, though. So tonight we're going to be talking about all manner of things. But while I was just hanging around here, just prepping for tonight, I thought I'd just go back and have a look at some of the things that hopefully interest more than just myself. And one of the things that I was looking at was the All Ordinaries. This is the Australian stock market, about 500 or so companies. And the Hang Seng Index, kind of as like a proxy for Chinese stocks. And I was looking back as far as the All Ords would go. So that's 2001, because our indices, the All Ords, has been around for a while, but yeah, it doesn't have as much data on it as some of the other stock exchanges does. But what it actually shows is that over this period, since 2001, the Australian market has outperformed the Chinese market. Obviously, it's been hammered recently, the Chinese market. But I think it speaks to this belief amongst some investors that, if you invest in some of these places where there's a really good story, like an economic story, like China, India, these types of places. Warren Buffett has said many great things in his time, but one of the things that he constantly rehearses is this idea of the stock market is not the economy. The stock market is not the economy. So that's really interesting there. And then if we compare it to, say, the S&P 500, which goes back a bit further together. So if we go the Chinese stock market versus the US, so this is back to 87, we can see the difference is even more stark. So the Hang Seng's done okay, and up until around about 2020, it was doing okay. But we can see a massive dispersion in the performance of the two markets since then. The US market's up 1,400%, not including dividends, by the way. And the Hang Seng's up 500%. And I think this is just a caution for everyone that sometimes when you think of like investing in these places, it's not always a good idea. Like so many good investors have over the past 5 to 10 years said how amazing it would be to invest in China or India for that matter. And it's not always as straightforward as that. So anyway, I hope you all are well. I do see there are some great comments. Rob's already in the chat from the Self-Wealth chat. Remember, if I respond to some conversations or some comments that you make, I may be responding to the ASA channel, the Rash channel, or the Self-Wealth channel. So I do apologize if it sounds like I'm talking to myself. I usually do, but hopefully not as much tonight. So let's get on with it, shall we? So have you subscribed already? Well, regardless of where you are, whether you're on the Rask YouTube channel, if you're on the Self Wealth YouTube channel, if you're over on the ASA YouTube channel, you're on Twitter, Facebook, LinkedIn, no matter where you're watching this, I'd love it if you could subscribe. It would definitely make Rob's day. Rob from Self Wealth, please jump in and have a look. CP, you're saying my age is compounding backwards. Well, maybe not. And thank you, Penny, for saying happy birthday. It was my birthday on the weekend, so I do appreciate that. Thank you. Compounding in reverse, CP, I'm not 100% sure. And hopefully you can't hear this rain across the side of my desk here. It's very, very loud. The joke for this week is I'm afraid for the calendar. Its days are numbered. That is my joke for this week. Out of 10, not investing related at all, but it is my joke for this week. I was pretty slack on the joke tonight. I was trying to find one and I just couldn't find one that was finance related, but this was at least numbers related, which sounds similar to finance. So coming up on Rask Live over the next few weeks, we will have most likely have Chris with us next week for a midday session. For those of you that haven't already answered the poll on the Rask channel, I can see that about 80% of you say that you prefer a Wednesday evening session over any other time. So that's great. Thank you for filling that out. If you are on the Self Wealth channel, good evening to you. I can see Jitesh has given me an 8 out of 10 for that joke. Thank you so much, Jitesh. Rob, you did put in the chat that if you haven't already joined the movement, you can get 10 free trades with Self Wealth using the link that Rob put into the Self Wealth discussion. So if you haven't already joined Self Wealth, you can. There you go. I think you may have reused that from a prior week on. Well, Harry, I may have reused that joke. It may be, although it may have been Drew, my partner in crime on the Australian Investors podcast. He'll be coming up in the next few weeks as well. So last week, I did say that there are some freebies up for grabs. If you haven't already checked it out, I know I haven't given any of you that much notice, but if you haven't already checked it out, the Australian Shareholders Association, so they're hosting an event, which I think some of you have already got tickets to. But the event is starting tomorrow. It's an online event, so it doesn't really matter where you are. You can view all of these things on demand. There's a bunch of on-demand sessions, and I think they are announced already. So if we go here and we go to the agenda, we click on this. So yours truly will be presenting at what time am I on? 1:45 with Gaurav Sodhi from Intelligent Investor on Friday, and tomorrow night on Thursday. Tomorrow night I'm talking about global investing with Brendan Doggett, the country manager of Sharesies. But there are a bunch of view-on-demand things. So I interviewed David Dicker, a company we're going to cover tonight. I interviewed Richard White, CEO of WiseTech. I interviewed Jonathan Boyer, Jim Osman. I did not do that one, and Ryan Joyce. So all of these are available on demand once you get your ticket. Good news is all of y'all can get a ticket when you use this link. Click on that and use the coupon code RASCOMP. You get it for free. So there's already 500 people attending the event. It'd be wonderful if you can go. Like I said, there's a bunch of view-on-demand stuff, so you can get it for free. Use that coupon code. You may as well sign up because it's free. Dare I say no more. Okay. Also tomorrow, if you're in Melbourne tomorrow afternoon, there is a retirement event for people over 45. This is from Wattle Partners. I'll put this in the chat here. Wattle Partners retirement event. I think they're going to do some around the country next year. Wattle Partners. This is retirement event. I'm going to drop this in the chat. That's Jamie and Drew's business. For those of you that are familiar, I think there's about 150 people going to that. So that'll be great. That's free. Get tickets to that. And then finally, some of you may have heard, this is one final event for anyone in Sydney NAOS event. NAOS, who appeared on the Rask podcast recently, they are doing a road show, and the final event is tomorrow from 10:30 to 12. If you want to grab a snack over lunch, go down to Sydney. It's at the Australian Museum. You can register there. So all of that's in the chat now. Go and check it out. I don't make money from mentioning any of this sort of stuff, just so you know. Although I should say that ASA is a sponsor of our podcast. But other than that, you get the tickets for free, so I don't benefit from it. Okay, so last week we talked about investing is like a farm. We talked about the Ulysses Contract by Michael Kent, which is a fantastic book. Please check it out. I reckon I was chatting to Mike over the weekend, And I reckon it's probably the best investing book in Australia. Like, I think, at least in recent times, there's been some great books, but I think from recent memory, I can't think of too many better than this one. So if you haven't already picked up a copy, go and check it out. It's a bit like, it's not, even though he worked with Scott from the Barefoot Investor, it's not really like an introduction to finance. It's more about stock market investing in general. Okay, so we're going to get to the other companies that we didn't cover last week. I know all of you are really keen for that, but I want to ask you a question, a very simple question, and feel free to just chuck it in the chat. How would you value this? And I do not mean this squirrel. I mean, how would you value a dry cleaning business? And just so you know that I triple check that I'm not going crazy, there is available for sale in Brisbane right now a high customer traffic dry cleaning business for sale in Brisbane. We'll click on that in a second. But did you know that you can search seekbusiness.com.au and find businesses for sale in your area? It's not just where you go to find jobs. You can actually go to find businesses there for sale. So please, oh, Bob, I can see that you've just bought Mike's book. That's fantastic. Very easy read, says Rob. Thank you, Rob. I'm sure Mike will be happy with that. Okay, so this business is available for sale in Brisbane. It's available for $260,000. That's the share price. You can see what sector it's in. It's in the cleaning and maintenance, and then the subsector is cleaning, dry cleaning sector. You can see it's listed on the Australian Seek Exchange, which is otherwise known as the ASX, the Australian Seek Exchange. Right there, it's in Brisbane. So Harry says, I'd pay 5 Diet Cokes for squirrel business. Well, if you could get the squirrel to do what you want, I think 5 Diet Cokes is pretty good. And to be honest, I don't like Diet Coke, so I don't think it's worth that much. Okay, so CP, you said you would base the valuation on its assets, any loans, and cash flows. Great. Owen, you said, I wouldn't at the moment until offices start pulling people back into the office more regularly. Okay. CP, you go on to say, and if the business is growing year on year and competitors in the area. Okay. So this is a legitimate business, guys. You can go and you can put in your information here if you want to, and you can go and buy this business after we're done talking about it if you want to. But I can see that all of you are already putting things in the comments about what you would look for. So we can see it's a dry cleaning business from the image, established decades ago. This esteemed dry cleaning business. Discover a local institution, stood the test of time, established decades ago, served generations, reduced price of $260,000. The current owner is looking to retire, making this a rare chance to acquire a well-established gem. Annual sales of $575,000. Valuable assets, so replacement value of $140,000. So replacement value, not the depreciated value. That wouldn't be on its balance sheet. It's in a prime location. It's got a good trained team. There's a good team in place. It's a loyal customer base, recurring revenue. It's a consistent profit earner, so earning stability. And you can see with low overheads, more than 30 cents of every dollar in sales becomes profit. So that's a 30% profit margin. Whether you're a husband and wife team, a family operation, or whatever, it goes on to say, in the industry, see, this opportunity is too good to pass up. I'll provide comprehensive training for sale, $260,000. Okay, so sounds pretty good, right? This is basically what we do on the stock market, but this is a real business. There are a few fundamental differences between what we do on the stock market and buying a dry cleaning business like this. Number one is the size of the business is often a lot smaller. So this is smaller than, say, Commonwealth Bank. Number two is typically you would run the business, or you would employ someone to run it for you. So there's that. Whereas if you buy shares in Telstra, you don't go in and run the company. And the third thing is the share price. The share price here is $260,000 because you get the entire company. Whereas for Telstra, there might be millions of shareholders, for example. And they might be trading for $5 a share. So there are a few fundamental differences. But at the end of the day, I'm glad that so many of you said this. So like CP, Harry, Owen, many of you, Jitesh, many of you have said what you would look for, like location, competitors, cash flow. These are all the things that we look for when we're looking at a business. Yet so many times people log into their, let's not say self-auth, but they log into their brokerage account, they type in a random stock code, let's go LKE, and they go, oh, look, stock price has done this, therefore buy. That's, in my opinion, a very risky way to invest, and it's most likely going to result in failure over time. And they get sucked in by some headlines or some figures and the share price going up, but they actually forget to look at the very thing that matters, the thing that they own, which is the business. But at the end of the day, other than those few fundamental small points that I mentioned, it's exactly the same thing. The only difference is you don't control the business. And so I want you to remember, as I hit the microphone, everything that we talk about when it comes to stocks, tonight or otherwise, is owning parts of businesses. And I do this exercise with anyone that I teach value investing because it just illustrates how important it is to check all these things. So what would be your answer, Owen? So CP, I would say, Laurel, you've asked, what is the discount code? The discount code is RASCCOMP, RASKCOMP, RASCCOMP. So what it would be my answer to something like this? I would say, as Aaron says, you're buying a job more than a business. Obviously, it depends on your predicament, but one of the big things is, are you able to work in it, or do you have a desire to work in it? If you don't have a desire to work in it, it means you need to employ someone. So if you employed someone, you'd have to calculate their cost, and then that reduces the profit, right? So according to this thing, though, they're saying that they've got $575,000 a year, and they're making 30% profit margins. So by my arithmetic, what's that, about 180,000? Does it say that somewhere? 180,000. So you're basically buying it on a price to earnings ratio of 1.4. 1.4. So your price to earnings ratio is 1.4, as opposed to, pardon me, let's go to Telstra. Its price to earnings ratio is 22 times. So that's the price, the share price to the yearly profit. I was just comparing, I was just trying to get to a profit figure based on this and the 30 cents in every dollar. So it's pretty cheap, but I definitely would negotiate down, and I would imagine you'd want to put someone in, and that person that you put into the business would be the person who is incentivized to grow it. So you want to make sure that they're the right person, which means you'd probably have to give up some ownership in the business. Missy, you've said you'd also look at the rental agreement or the lease agreement. So important for small businesses. Small businesses often get crippled by leases. Simon, you've said, I would be wary of businesses for sale. I've seen many in my area up for sale, all saying they're flush with customers, yet I don't see many walking past. Such a good point, Simon. So if I was going to buy a business like this, the first thing I would do would be to go and stand outside of it and see how many people are actually going in, and then use its services. Speak to customers. Go around the neighborhood and see if there are some competitors. This is what we should all do with the companies that we invest in, but just most of us don't do it. Anyway, I thought this was a good analogy to break down the barriers between what we do as stock market investors and what actually is reality. Obviously, the stock price can vary up and down in your brokerage account, but at the end of the day, you get what you pay for. So I did say a few weeks ago, last week, about we at Rask, when we're building a model portfolio, we use ETFs as the core component of our portfolio. And that would be the dark shaded area here for Australian shares. Now, we use ETFs predominantly, but you can have satellites around the outside, and those might be individual businesses, or they could be more speculative style ETFs. We also plotted on the chart last week where each of the companies would fall that we look at, and we'll do that again tonight. So some companies on our list may be earlier stage companies, and down here, some may be in the fast growth phase, some may be at maturity, and some may be in decline. One of the problems that investors make is when they look for dividend yield, say if they're in their brokerage account, they look for dividend yield and they go, oh, look at that, it's got a huge dividend yield, but not realizing that the business is actually in decline. And the only reason the dividend yield is high is because they're basing this figure off last year's dividends and the share price is falling. So it makes the yield look higher. And so I can get out of these now. Get rid of them. There you go. See you later. So a lot of people get to businesses, income investing, and they think, well, long-term investing in dividend stocks is about finding the stocks with the highest dividend yield, which last week we showed that is completely the wrong thing to do. You want to invest in businesses that are growing because it means A, your dividend is secure, but it also means the share price will likely go up over time. So last week we also talked about that dividends, there are some rules for why dividends won't be paid. Like legally, companies are not allowed to pay dividends under certain scenarios. However, dividends are also optional. So even if they do meet these rules, there's no guarantee that the board of directors will approve a dividend. It's up to the board to approve a dividend. And finally, before we get to the companies, we did a few calculations. We realized that sales minus costs equals minus the tax and interest equals your profit, and a percentage of the profit can be paid out in dividends. Hopefully, though, some companies can retain enough profit that they can then also grow as well as paying dividends. So in this instance, we would hope that a company can pay some dividends, but then also can reinvest back into the business. I'll just put reinvest just as an RI. And then that leads to more sales in the future. Now, one of the companies that we're going to talk about tonight does not do this. So it does not pay it does not retain a lot of profit. It actually just pays 100% of its profits out as dividends each and every year, which is a fascinating thing when you think about it. Okay, let's move on. So the companies that we talked about last week were Wesfarmers, and they got a tick for every box. They're the owner of Bunnings, Officeworks, Kmart, and these types of things. We did SmartPay, and SmartPay got a tick for everything except this bit right here. It was rapidly growing. It wasn't yet paying a dividend, but it could in the future, because we said to ourselves it's probably around about here. But for the most part, it ticks a lot of the other boxes. So now, why don't we talk about another business? CP, I can see you've got a comment in the chat, but why don't you guys pick, out of all the remaining companies here, which one should we target first? And while I wait for you to pick, I will respond to CP's message. CP, you said dividend yield is backward looking. So not the right metric for future decisions. Absolutely. We have to say in finance that past performance is not indicative of future performance. But that's because most people who use past performance as a guide to the future simply bloody look at 1 year's worth of returns. If they looked at 10 years worth of returns, it might be more predictive of the future. So what I prefer to say is history is a pretty good guide, but it's not perfect. And when I'm talking about history, I'm talking about the company's operations, not necessarily the share price or anything like that. Okay, so I can see everyone's basically commented on every company except Lovisa. Oh no, Paul said Lovisa. Penny said Lovisa. Okay, so basically you guys chose everything. There's no clear winner. Maybe I'll start with Macquarie, because that's what Benny and Owen got into first. Okay, we'll start with Macquarie. So Macquarie is very different to the rest of these businesses here. Macquarie is a bank, and it's a investment bank. So you can think of Macquarie Group. Macquarie is not the university, which is what my Uber driver thought I was talking about the other day when I told him to look at jobs at Macquarie, because he was a data engineer. And I said to him, well, Macquarie is investing in a lot of technology people at the moment. You could get a job there. And he thought I was talking about the university. I said, no. You'll get paid a lot more money if you get a job at this Macquarie. So Macquarie, if you come here and you see all this stuff, you think it's just like a normal bank, right? It's like CommBank or anything like that. But it's actually really not like that. It has moved into this area in the last 10 years or so, but Macquarie's history is actually rooted in more on the investment banking side. So by that I mean it does things like investment management. It does a lot of things in the financial services world. It does things for fund managers. It even does what we call infrastructure or asset management, where it will actually manage things. It will do commodities trading. mergers and acquisitions, and the list goes on and on and on. And that's traditionally where it's made most of its money. And you can see that reflected in the financials, because if you go through and if you actually look at, so when you look here inside self-wealth, this does a very easy job of it. But if you look here, this says net interest income. And what this is actually showing you is this is showing you the income that the bank makes from banking, like from lending money, right? But if you go down here and you click on non-interest income, this is for all the things that are not related to lending money. So it might be like fees charged for certain services, these types of things. Now, if we go, and I'll actually get rid of net and I'll do interest income. So I'm just comparing the two gross levels. And what we can see in this chart here is non-interest income is a bigger proportion of the bank's revenues than the lending is. So the gray line shows you all the stuff that's not lending. And you can see it's growing and it does really well, but it is a bit volatile from year to year. Now, if we go to CommBank really quickly, and we go down and we look at its same figures, interest income and non-interest income, we will see a complete reversal. So here we can see the opposite is that Commonwealth Bank makes almost all of its money from actually lending money to homeowners and to businesses. So it is the opposite for Macquarie Group. And Macquarie is a globally diversified bank. So it's quite different to the Australian, the big banks, the big four, like NAB, CommBank, ANZ, and Westpac. And so what this basically means is you have to actually look at Macquarie through two different lenses. I'm just going to bring up the annual report, although I think I already have it. Oh, here we go. This is the most recent annual report. One of the things that happens with banks is that makes it a much more challenging thing. I'm just going to type in comprehensive income statement. If I can get down, here we go. One of the things that happens with banks, which makes it much more complicated for people to understand, is that basically the bank makes money from interest, but it also makes money from other things like, here we go, commissions, trading losses, like commodities trading, these types of things from joint ventures, and then you've got some things to deduct. And basically there's even an other section here that is just a huge amount of income for them. But basically, you have to judge the business differently than if you're just running through this checklist. Of course, we look for the same things, but the profit and the cash flow is going to be different in just a second. So let's have a look. Let's go to sales. So we know from, well, just based on what we can see here inside self-wealth, it looks like it's growing. Get rid of the interest expense, non-interest income. So we can see that the bank is growing. It's a nice upwards trend over 10 years. So fundamentally, sales are on the way up. So that's good for Macquarie. Is it a defensive business? There's something that people kind of neglect to remember. But during the global financial crisis, Macquarie's share price, just imagine this for a second, fell from $95 down to a low of $16. So from $95 to $16. Trust, I can see you just asked a question. Can we do Dicker data? We'll do Dicker data next. How about that? So what we can see is a huge decline. And this is at the time when all of the big banks around the world were plummeting. Some of them went out of business and so on and so forth. Then again, we can see during COVID, it went from $146 to $85 virtually overnight. This is a company that, despite its size being $63 billion, is incredibly volatile. The share price, people's perceptions of what will happen to this bank vary depending on which side of the bed we wake up on. So for the most part, it is a really, really defensive business under the surface because they've put in a lot of changes over the past 10 years. However, I probably wouldn't say it's really defensive. Like you wouldn't, well, I would if you actually understand the business, which is the next part. But for most people, they clearly don't understand it. So you just got to expect that it's going to be volatile. So rather than a tick or a cross, I might just put one of those wavy lines through it. So it's kind of, it is a defensive business, but you've got to strap on because it's really volatile. You've got to hang on to this roller coaster as it goes up and down. For what it's worth, I think Macquarie is the best bank outside of Commonwealth Bank. And if there was two that I'd pick, it'd be those two. Anyway, so is it a business you can understand? We can find out that Macquarie does a lot of the usual business banking things. Like you can see, it will say in this gigantic 308-page annual report, if you bothered to read it. And you will see that it does a lot of the usual things. But one of the things that Macquarie does is it's actually, I think it's in the top 20 businesses in the world that manages infrastructure assets. So let me just go down the bottom. Where's the About Us section? Is there an About Us? I'll just Google it. Macquarie About Us. So there's actually, sure, accept cookies, no worries, Europe. So if we click on this thing, asset management, we can see that Macquarie manages approximately $871 billion of assets globally. This makes it, I think, in the top 20 in the world for managing assets. So this could be anything. It could literally be from investment portfolios to infrastructure to so many different things. And so that gives you a sense of how big it is. You can go through and you can look at all the different businesses that it has within it, but I'll give you a high level understanding. Macquarie's asset management. So this is where it might make fees from roads and this sort of stuff. You can see one here, like toll roads, whatever. It also may make money from funds management. Here we can see banking and financial services. So this is where it's mortgages, it's financial advice and wealth management falls into. Over here in the commodities and global markets, this is where it's a traditional investment bank, and it might help companies trade iron ore, might provide futures contracts on coal, all these types of things, and help businesses do business globally. And finally, Macquarie Capital over here is the company's investment arm. This is where they have funds management businesses. They might offer investment products and so forth. So that's basically a high-level understanding of the business. They're investing heavily in all divisions, but this one in particular right here is where they are spending a lot of time. And the reason is having a mortgage and offering a mortgage to a customer is much less volatile for Macquarie than some of these other business lines like commodities. Like if you dig into the financials, you can see that the commodities income can bounce around all over the place. That's because one year there might be a lot of trading in, say, for example, energy prices. And then the next year, coal is way down and there's not as much trading happening, so they can't make as much money. Whereas someone's always basically going to pay their bank, their mortgage. So that's how the business works. Once you have a high level understanding of it like that, you can understand it. It's just very, very technical below the surfaces. Below the surface. Even here, for example, here we can see we'd have to know if we wanted to be professional analysts, we'd want to know like what are these things right here? They're very small now, but could they turn into much bigger things? And we want to go back and study it during the GFC and see how it behaved and what it reported. If we go down to the cash flow statement. Now, this is where things get a little bit interesting for a lot of people. Because when you look at a bank, because remember, we're trying to find strong profits and cash flow. We know it's got strong profits, but does it have strong cash flow? They're similar but different. This would be like if we go back to our example of the dry cleaning business. The dry cleaning business said that they have something like $150,000 of replacement value in equipment. But replacement value doesn't actually mean the actual value. Like the actual value of that equipment today could be $40,000 because it could be old and tired. And so this is an example of like where profits can differ to cash flow. In some instances, profits are higher or lower than cash flow. But for Macquarie, this is where things get a bit murky because it's pretty hard to understand what's actually happening. Because remember, it's got traditional banking, but it's also got like commissions and fees and stuff like that. But then it's got the rest of its normal business. Then it's got things like the loans that it gives out. Then it's got things where it gets the debt from in global markets. And then it's got a negative cash outflow. So it's using cash this year, whereas last year it brought in cash of 50 billion. It's very, very hard to understand the cash flow statements of banks. So that's why a lot of people kind of just take it on face value and they go, yeah, it's regulated. Yeah, it's okay. Very, very hard even for analysts to understand. So I would say it's got strong profits and it does have strong cash flow if you untangle it all. But at the end of the day, it's pretty hard to understand. So I'm just going to put like a bit of a line through that. Aligned management, it definitely has aligned management. They get paid huge bonuses. They've got a fantastic CEO. Let's see if we can go to the remuneration report. Page 102 for those people that do read all the way down to that. So they call they call Macquarie the Millionaire Factory because it is a place where a lot of employees, talented employees, can go and make a lot of money because they have all of the things at their disposal to do that. And rather than read through all of this, if you want to do this, you can go and read it in your own time. The business is always really well incentivized its employees, and they've kind of got the results that speak for themselves. And so I can see Paul. Why would you describe Macquarie as defensive? Says Harry. I don't know if you're talking to me. CP, you've said Macquarie's engine is its asset management / investment banking division, which for the most part is quite opaque to the retail investor compared to the big four who rely on home loans. I'd agree with you, CP. It is a massive part of their business, but they're trying to invest more in their retail banking to look more like a normal bank, if that makes sense. I can see you all are talking about super because someone started talking about super further up. So Owen, you said Macquarie have one of the top recommended cash management accounts for SMSF. Strange, but true. There you go. So Macquarie do have very good banking products, by the way. Their term deposits, their savings accounts, their all that sort of stuff. They're very good. Anyway, rather than spend too much longer on this, because we do have a few companies to get through, we can see the tenure of executives, number of years at Macquarie. I love to see long tenured employees. Look at that, the number of tenure at Macquarie. That's great. That's exactly what I want to see. So this is a positive. All in all, I'd say the company pays its staff extremely well, but they are aligned. They've been retained for a long time. They've done a good job of that. Is the business available at reasonable prices? So this is the valuation. Rather than get stuck into it, if I was going to value a business like this, I would probably just use the price earnings ratio method that we went through a few weeks ago, where we look at the PE in the future. Or for a bank, I would use the price to book ratio and study that through time, and then do the same thing, or study it based on dividend yield. For example, one of the methods you can use to value a bank stock is very simple. It kind of assumes a lot of things. That's not it. So you go like this. Now, this looks like a lot of math. You probably think you're back at school, but basically what we do, and it's got everything there, is you basically just take the dividend and you apply a growth rate to that, and you assume that the dividend is going to grow at a certain rate forever. And then you just do the calculation as it's shown there, and it comes up with the valuation. So there is a dividend discount model. So if you are going to value a bank, you can use this one. This is a free tutorial that I put together in 2018. Jesus, I feel like I'm old. So this is called a DDM model, and you can see that there. In this video, I actually take you through how to do a dividend discount model of Woolworths. And it's really simple. You can apply it to banks as well. So there you go. You can go and check that out. But at the end of the day, let's have a quick look at the valuations according to the forecast inside Self-Wealth. So if we look down here, we can see a target price is not that many analysts covering the stock, but $192 a share, currently $163. Obviously, we don't rely too much on these analyst forecasts, but it's good to know what everyone else is thinking. In the community, 82% are bullish. Chef Circle, you said 2018 is like 200 years ago. It feels like 200 years ago. Anything pre-COVID feels like twice as long, in my opinion. I guess it was just a long time. So reasonable prices, according to analysts, they say yes. I haven't done a valuation of it recently, but according to analysts, they say yes. We probably will do a valuation of this. I'll get one of the analysts at Rask to have a look at Macquarie in the coming months, actually. It's actually a good idea, and maybe they'll do a valuation for us. So I'm going to give it a kind of a tick because according to analysts, it's cheap. Let's have a look at the dividend yield. The dividend yield is 4.6%. It's partially franked, not fully franked, but it is a cyclical business still. So you want to keep that in mind. I would say you want to be buying Macquarie when the shares are actually falling, not when they're rising. So let's give ourselves a bit more time. So maybe it starts to get interesting soon. Maybe now's the time to start researching. I definitely have Macquarie on my watch list because I think it's one of the 20 best companies in Australia. I just don't know. I just don't have an exact answer for you guys tonight. That's all. Macquarie's result is out next week, says Chef Circle. There you go. So why don't we wait for that next week? So all in all, I think Macquarie ticks a few of our boxes. Let's put a little number beside it. It probably ticks out of the 6 boxes. It probably ticks about 4.5. Let's now go to Dicker, the mighty Dicker. So does anyone want to have a guess at what Dicker does? And who was it before that said, I wish I knew what it does? So what does Dicker do? Trust, fall, lol. You asked, what does Dicker data do? Is that alliteration? Dicker data do? Sounds like something. Sounds like something Winnie the Pooh would say. Harry, you've asked, it says, sell data. Mr. Morker says, Dicker warehouses IT technology. I think that's a good way to put it. Software and hardware distribution. Mr. Morker said, I get a lot of boxes from Dicker Data. Oh, do you? Cloud servers, says Paul. Makes ticker tape, says Neil. Something IT, says Stuart. IT hardware, says Missy Ivan. Okay, sells stuff for more than it costs. Yes, but not much more than it costs, Martin. So tongue-in-cheek response from you, but it doesn't sell it for much more than it costs. I actually caught up with David the other day. He's a character. He's wonderful. So if you want to get a bit more of a sense for David Dicker, he and his partner, mostly him, I believe, but him and his partner founded the company. But I think this little interview I found quite humorous when I was researching David. So founder risks at Chef Circle. Builds F1 cars. Yes, he tried to get into the F1, but this gives a sense of about him. So there he is on his private jet. Anyway, the business. What does Dicker Data, the business, do? So the business, as Mr. Morker said, it is a distribution business for IT equipment. So literally everything that you can imagine. He started by going to the US back in the day. His father, I think it was his father, had a truss business, like a roof truss business, like things that hold up your roof, right? And David discovered that computers could be used to measure the angles and to do the calculations for what trusses need to go where, what type of timber they might need for the roof and these types of things, right? This is all covered, by the way, in the upcoming investor summit with the ASA. So if you do get a ticket, you can go into that. I'll see if I've got it. I'll show you a bit of backstage action here. Enter event. I think I'm registered, so we'll find out in just a second. Okay. Oh gosh, no. Okay, I don't have it. Anyway, you can actually go in and you can see that David's recording will be in there. So get yourself a free ticket using RASComp as the coupon code, and you can watch that tomorrow at your leisure. Anyway, he started with his roof truss business and he found out that computers could do it better. So what he did is he went to the United States and bought a couple of computers. This was in the 80s, I believe. And he saw that the computers were there and he could bring them back to Australia and use them in his dad's business and do the calculations and what have you. So he took that idea and then slowly increased. Eventually, in the beginning, Dicker Data was a business that only sold to individuals. So you could go to Dicker Data and you could go to David and say, hey, David, can I have a PC computer or something like this? Now it's just business to business. So now it is just a distribution business to other businesses. So if there's another business like a Videocraft or one of these businesses that sells computing equipment, they might use Dicker Data to get that equipment. Mr. Morkra in the chat, why do you use Dicker Data? Why do you get so many boxes from them? I'd be keen to know if you're willing to share. Harry says, David looks like an older Julian Assange. Interesting. Okay. So let's have a look at the business. Let's go in and look at its financials. So here's all the stuff that it's selling, basically everything. And if we go down, it also is increasingly going to software not just selling the hardware components, and it is also trying to find more annuity style business lines. So if we go to, I want the actual, this is the actual one. Okay. So this is the actual income statement right here. So we can see it made $3 billion of profit, up from 2.4. Oh, Mr. Morker, here you go. I work for a large mining company that has been in the news lately. I set up IT technology. Oh, cool. Okay, well, there you go. So you would have access to Dicker data and be able to buy things through it. So you can see sales are up dramatically in the last year. You can see that there are a few other things like recoveries, doesn't really matter too much. They've received a bit of interest. So $3.1 billion of income or revenue for the business. You can see expenses here. Most of the expenses are actually buying the equipment. Almost all of it, in fact. There's only, 300 million left over or so. You can see employee benefits expenses, 130 million. They've got a bit of depreciation, some financing costs from their debt, obviously, other expenses, and you can see a change in inventories. So basically what happens is the business makes this much in revenue, and then all of this goes out the door. So if we jumped into self-wealth and we looked at the financials, and I'll just go there. The ticker symbol, by the way, ladies and gentlemen, is DDR. If we go into the financials, we can see revenue growing. So that's a tick. So first thing gets a tick. That's good. We can see, if we get rid of that, we can see the net income or net profit. Let's compare that to revenue. We can see it's tiny. Even though the sales are going up, the revenue's going up much slower. I mean, it's going up in absolute dollars. Like if we get rid of the revenue, we can see it's climbing. So it's growing there too. So strong profits, it's growing. But let's have a look at the cash flow. So if we go back in here, if we get rid of that and we go to the cash flow statement over here, and we go cash flow from operating activities, which is this one right here. This is the one I want to see. And what we can see here is it's kind of muted, right? So maybe we need to investigate why that is the case. If we go down to the cash flow statement, or we'll go to the balance sheet first. So it's got $12 billion of cash. It's got a lot of inventory sitting in its warehouses right here. We can see that it's got some debt. It's got $240 million of debt. It's due soon. $50 million there. So nearly $300 million of debt and only $12 million of cash. If we go to the cash flow statement, we can see that it's paying a lot for its employees and for its suppliers. It's paying a lot. Look at that. We can see that it actually just broke even on a cash flow basis. It's spending a lot on property, plant, and equipment. We can see that it's bought another business. So we can see it's bought a couple of businesses recently, net of cash. So ultimately, the business has gone backwards from a cash flow perspective. So cash from financing activities, all in all, net cash flows gone backwards last year because of the acquisition, because of the big dividend paid. And this year, it's also, it's just broken even from cash flow. So it is positive, but it's not super positive. So Mr. Morker, you said you don't use Dicker data directly, you do it through resellers. So Dicker is such a large product mover that usually you go to a channel partner. Yeah. Dicker expenses, private jet, no operating leverage. So yeah, so the leverage here, there is operating leverage, but it's off a very low base. So this type of business is what I would call high volume, low margin. It's kind of like a supermarket. Sells a lot of stuff, doesn't make much profit on every can of baked beans. It does make some, but not a lot. So what you often get with these businesses, CPs, you don't get operating leverage. By that I mean you don't get a lot of revenue growth equals profit growth. But what you do is you get financial leverage. So the companies are able to make acquisitions or use debt to grow. In speaking with David, he thinks the business can actually keep borrowing money in order to keep growing. He thinks it's capable of sustaining that. And I think it's really important to note, here's this, they actually have a fantastic culture as far as I'm aware. Like they pay people a lot, like they get the job done. They're not there to muck around. But Vlad here, for example, got a huge amount of shares in the company once he proved himself. They do a lot of internal type hires and these types of things. But here we can see that he still owns 58 million shares in the business. His ex-wife owns about 50 million shares in the business. So all in all, if you got 50 million shares and the share price is $10, that's a lot of scratch. A lot of his money is on the line. So you can guarantee that it is not in David Dicker's interest to blow up the business. And so I highly encourage you to go and check out that uh, conversation I had with him, because it will allow you to get a better appreciation of how he thinks about the profit margins and these types of things. And one of the questions he always gets, is like, how do you afford to pay out so much in dividends? And there is a wonderful chart that they give. Where is it? Oh, I can't. It's not in this doc, but there is a chart that they normally do which shows what we call a waterfall of where the money goes. And I would say that for the most part, it is something that people should be aware of. But the business has always been very small profit margins and very, very well run. And some people, that doesn't work for everyone. I think for a small part of a portfolio, it can work. I think someone mentioned before that the business is a bit founder dependent. It's probably fair enough. David is kind of like the ethos of the company, but that's probably one risk. But the management are incredibly well aligned. It's a business that most of us could understand if we put in the effort. For example, if you go in, you will be able to see. You will be able to see the types of businesses that they're selling for and the types of businesses that they're selling to. So basically, if you get any of this type of equipment here in Australia, it's very likely that it came through Dicker data. Any of these types of things, I'm sure many of us have seen, like for example, where was it? Logitech video camera, or like a webcam, or Microsoft products like Dell. So many of these products that you would be using, or your company would be using. And the thing that obviously, it's not always the type of business that I would look at just because of the cash flow. But I think if you're interested in regular dividends, it's a pretty good business. Is it defensive? Well, it kind of is, because it has survived a very long time. It sells a very important product, but it does have to adjust and develop to the world, adjust to the world, sorry. So if we go down to something, I've told you guys about this before, but in every annual report, there should be something called a segment report. And if you go down here, you can see where they make their money. So you can see different types of things that they are selling down here, and you can see how they're selling it, which is really interesting way to see how the business is growing over time. But not this one. I don't think it was in the latest one either. But the business has been moving more and more increasingly into software and these types of products, and has recognized the cloud and cybersecurity as major ways to grow. So I think for the most part, Dicker can keep growing for quite some time. I'd say it's more defensive than some businesses, but I wouldn't describe it as really defensive like a Wesfarmers or a Soul Pat style business. So I'd give it a kind of a tick in here. Is it available at reasonable prices? Well, I kind of think so, to be honest, because the shares have been sold down. And if we go to what analysts are saying in here, course, this is just analyst forecast, not my forecast. I want to be clear about that. You can see they've got a $10, what have they got? A $10.40 price target, and that hasn't really moved over the last 3 months. So that's pretty good. Analysts are pretty comfortable with where the valuation is. I would just say needs more research, but I would say it ticks a lot of boxes. I'll give it one of those. So for the most part, it probably gets like a 5.5 on this quick dividend checklist. Okay, so probably got time for one more company. We have covered a lot of Soul Patts, and we have covered a lot of Washington H. Soul Pattinson of Lovisa recently. So we have covered a lot of that recently. So I will probably skip that and jump straight to Cochlear. Can I get, does anyone here in the community, Jenny, can't see Apple on the list. Yeah, you won't. Apple does a lot of its own distribution channels, even though it might sell through JB and these types of places. It's very, 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 very protected brand. Can someone tell me, does anyone in in the chat tonight that's following along tonight, does anyone here use a Cochlear device or know someone that has? And what has been your experience or their experience if you have? CP, you've said Vlad for Dicker Data is the same as Victor for Lovisa. Management are heavily cash incentivized. Yeah, I mean, Brett Blundy in Lovisa's case, good point. I don't actually mind seeing really important people heavily incentivized. I don't have a problem with really important people in businesses getting rewarded for their effort. And particularly if they've been there a long time, because it's actually a pretty good feature of the business to reward people. Because I've always had this view that I think it's unfair that some people in a business get paid so much more than people further down the chain. And I think the old, proportion of the CEO's income versus the kind of like the lowest level of income. I think more people should be eligible to participate in the long-term growth of a company. So, Daniel, you said, I am a GP and I know about this company, Cochlear. PDB, you've said Sol, Wes, and Macquarie are my pick from this list. Good list. Lyle said, what do you mean by sold down from the share price? When I say sold down, Lyle, what I mean is when I talk about that, what I basically mean, or what we mean as an industry, is the share price has fallen. So Dicker Data was about $14 a share back in late 2021. It fell to a recent low of $8. So that's a pretty big fall for a company. It's like 40%. Chef Circle, is Sol worth paying for at above NTA? Probably, to be honest. Maybe not too far above, but yeah. Okay, Daniel, so you've had some experience with Cochlear. So most people know what Cochlear does. Cochlear creates the implants that help people hear, basically. So implantable, here we go, Cochlear, with cochlear.com. See if that comes up. So Cochlear performs basically a surgery, not through its own surgeons, but through third parties who are trained to use its devices and install them. If you've ever seen people that have just behind their ears, they look like a hearing aid, but they look almost like, dare say, like little screws into the skull. That is a Cochlear implant device. And these are not things that you can just go and pick up from the local shop and put on yourself. These do require experts to install, and it does take time for people to recover from this surgery. The way that the business basically operates is that insurers or government bodies fund the program and the rollout of these devices. And Cochlear is increasingly making money from things after the original installation. So they're making more money from consumable style things and from the accessories that go along with it. Cochlear's business is actually remarkable, in my opinion. I think there are some risks that present themselves to Cochlear's business, such as there is currently underway, there are some trials being undertaken for gene therapy to try and increase hearing in people that have suffered hearing loss. But we're still a long way from that. And in fact, Cochlear is also investing in that. There is also a competitor out of China called Neurotron. Neurotron, from my understanding, is actually using the technology of an American company to sell in China for cheaper than it costs for a Cochlear device. But it's not that much cheaper in China. Cochlear has different price points around the world. All in all, it can cost around $21,000 to use and have this Cochlear device installed. But you can imagine that this is the way I think about this business, is that if you are investing in your hearing, you are very likely to want to invest in the best product. If it's for yourself or for your children, in this case here, this is not something that you want to cheap out on. So I think for the most part, Cochlear has brand reputation, and it is a very, very strong brand throughout the world. And then once it is installed, it's incredibly unlikely that someone is going to take it out and go through the hassle of using a different device. The accessories that go along with the Cochlear devices, as far as I know, can only be used with Cochlear accessories. So like you can't use anything else. It'd be like if you have, how Apple has their own chargers, basically. You can't plug a Samsung into an Apple charger. It's basically the same thing. So you might be thinking, well, this is a wonderful business. How often do you get the chance to buy it for cheap? And that is the key question. Not that often. There was, however, a chance to buy Cochlear cheap many years ago because there was a product recall. They basically did it as a voluntary product recall. I think it was around this time here in 2011. And basically, this is a wonderful business that has a very strong competitive advantage, that sells a world-leading product that benefits from a falling Australian dollar because it sells overseas. So this is a business that is, in my opinion, exceptional. I said before that Macquarie is probably in the top 20. Cochlear's got to be in the top 10 companies in all of Australia. And you might not get an opportunity to buy it dirt cheap, but it's a business that I think over time, if you do get the chance and you are following it, that you can buy it cheap. It's a good business. So is it a defensive business? Absolutely. The company is dependent on people selling the device and surgeons using it. So there's that risk. But Cochlear's business has a return on capital. So this is the profitability of the business of over 30%. Even during COVID, when surgeons couldn't do the surgeries, the business still had a positive return on invested capital. Sales are growing. Let's have a look in here. Financials. So if we look, income statement, we go to revenue, I'll go total revenue. Sales are growing incredibly well. So they're up nearly 10x in 10 years, which is just unbelievable growth for a business that people thought was mature. It's a business you can understand. Just remember the key components that I mentioned. People get these devices installed by surgeons. So the surgeons have to be trained to use the Cochlear devices. The surgeons get paid basically from insurance companies in the United States or from like Medicare and these types of things. The individual has to undergo a surgery. There is a post-surgery process where they recover and they, get acquainted with the product and hearing again, and then they can use accessories and they're very unlikely to leave. That's the sales cycle. That's the business model. Is management aligned? Yes. Lots of internal hires at Macquarie at Cochlear over many years. The business did transition CEO a couple of years ago, which I'll come to in a sec. Strong profitability, strong cash flow. The question is, you don't get it at good prices. You've got to be patient and wait to buy the company at a cheaper price, in my opinion. So if we just see what other analysts are thinking, if we go here, you see it's not this thing. Was I on the Dicker Data thing the whole time? I was on the Dicker Data thing for sales, wasn't I? I need to keep going. Okay, so here we go. Cochlear. Average price target of $242, so about fair value. If we go back to financials, I go to total revenue here. So we can see revenue. I got it wrong before. I was talking about Dicker Data. So we can see here total revenue growing rapidly for a mature business. So a wonderful business. If we go to cash flow, get rid of this, jump across here to cash flow, cash from operating activities right here. We can see positive, very positive the whole time. $360 million a year of cash flow that the core business is generating. Super profitable business, super cash flow positive. Very good business, just very expensive as Chef Circle, 50 times PE ratio. So I'll respond to your question in a second, Cameron, 1 second. So all in all, I think Cochlear is like a 5+ star business for dividend income. The problem is the dividend looks lower because the valuation is higher. When you get the chance, and if someone finds a reason to doubt Cochlear, that's when you want to buy it. All of these businesses are quite wonderful, and I saw a few of you already putting them in order. I'll give you before we say goodnight, can you tell me, of all these companies, which are your top 3? So which are your top 3 out of the list? We know a little bit about all of them. Tell us what you think. I'll give you my top 3 at the end. Not a top 3 to buy right now, but just top 3 businesses to study over time. Because as you know, I spend most of my time investing in ETFs. Okay. There was a good question from Cameron. You've said that your goal is owning a farm down the line. That is correct, Cameron. Do you have any agricultural stocks on the watch list in the meantime? I do not. I used to have some agricultural stocks on the watch list, like Rural Funds Group. There are businesses like John Deere and those types of businesses. But the way I think about it, Cameron, is even farmers use Google search. Even farmers use Apple, Microsoft. So just by investing in those businesses, you're getting some exposure to them as well. So, Jason, you've said Washington hates Sol Pattinson is an auto buy. Neil doesn't like any of them. That's fair enough. Neil, you don't have to like any of them. Robert said Sol, Macquarie, Wes, Chef Circle, Wesfarmers, Macquarie, Sol, Martin, Sol, Wesfarmers, Macquarie, CP, Sol Pattinson, Cochlear, Macquarie. So, Missy Ivan, you said, I'm not familiar with South Wealth. Is the platform you are using a premium offer? So, as Paul's just said, you can sign up for an account, Missy. It's free to get an account with the likes of South Wealth and brokerage accounts, depending on where in the world you are located. I'm not paid to say this, by the way, but yeah, you can sign up to a brokerage account and you can access things, or you can just use Google. Penny, you've said, I finally bought Lovisa today after watching it for months. Well, good for you. Good for you, Penny. I know you've said it a few times, so good for you. Okay, so I'll give you my three. I think if I'm looking just for dividends, excluding everything else, it's probably going to scare some of you. I'll go Washington hates Sol Pattinson. I'll go Macquarie. If I could buy Cochlear at the right price, I would. That would be my number three. But I can't. So it's out of Wesfarmers and SmartPay. The reason I'd go Macquarie is because I think Macquarie in 10 or 20 years from now will have a very big dividend. And I think Sol Pats is a very resilient business. I think Wesfarmers is too with its Bunnings franchise. I just don't like the other businesses that much, like Kmart and all of that. I think SmartPay doesn't pay a dividend right now. And it's a little bit speculative because it's so small, but it's an interesting business. So maybe I will go Cochlear for number three. Those three right there. Very low risks, as Jason is Wesfarmers. Yeah, it's out of those three, then probably Wesfarmers. And for dividends, SmartPay is quite a risky investment. Okay, so we've covered a lot. Let's just quickly jump up the top here and let's talk about where on this chart would we put, say, Cochlear? Is it in the launch phase, hypergrowth maturity? Where on this chart would we put, say, Dicker Data? And where on this chart would we put Macquarie? So where would we put them? Remember, this is the chart where we're plotting the growth of these businesses over time. What do you think? CP, you've said, how many stocks would you be comfortable with in your portfolio? Well, ETFs are the primary way for me to invest these days, CP. So I use ETFs for the most part. But then around the outside, I could have 20 stocks, 30 stocks, to be honest. Depending, if it was like me and the analyst team at Rask, 30 stocks, that'd be fine because the team working on it. I can see Daniel said Sol and Cochlear only. So you said all of those businesses at maturity, CP. Jason, you said Cochlear is in this hyper growth phase. I'd probably agree with that. Maybe it's like up here, Cochlear. Maybe it's at the second part of this chart. So maybe it's up here. Mark, you've said all four of the businesses are in maturity. Everyone seems to say the same thing. CP, you've said it seems too high, Owen. What do you mean by too high, CP? Tell me what you think. Okay. Robert, I picked your first two. Yes, you did indeed. A lot of the graphs are available for free, Missy, on Inside Self Wealth. So I would say a lot of the businesses are here. I would say Macquarie's in this area too. Macquarie's not exactly hyper growth, and neither is Cochlear. Dicker Data is still growing quite well, even though the revenue for Dicker Data is up here and the profits down here. It is still growing. I would say Lovisa's, we already know that Lovisa's in here. We already know that Sol Pats is up here, but that's okay. Wesfarmers we plotted last week. So too many stocks, you mean. You have 30 stocks. So I want you to imagine this, CP. So if, let's just say that this was $1 million portfolio. This is the 50-50 portfolio we've designed at Rask, right? It launches soon. So this portfolio is a real portfolio, and this portfolio launches in the next 2 or 3 weeks for Rask, right? So this is our 50-50 portfolio. It's mostly ETFs, but there's a managed fund in there as well. So if this was, say, if I had $1 million to invest, right? This is general advice only. But if I had $1 million to invest, I would put, depending on who I was, but for me personally, I would happily put $900,000 in the core of my portfolio and then leave $100,000 around the outside. However, that's me probably picking individual investments for the public. If it was me by myself and I didn't have anyone following me in and I was being a full-time investor, I'd happily have a lot more in my individual stocks. So having 30 different stocks for me, if it was my full-time job, would be fine. Like, I think there's one path in my future where I step back from being a public investor and helping other people invest, and I actually just do it for myself. And that's probably, 10 or 20 years away for me. But at that stage, I'd be happy to own 20 or 30 different businesses. That's fine. I could easily keep up with that. It's when people start owning like 50 or 60 stocks while they're trying to have their own business or their own job and they're not focused on it. I think that's when you get real issues. I hope that makes sense. Okay, so I'm going to end with this quote, and this quote comes from this book that's right here in front of me. I'll just move my drink bottle out of the way. Comes from this book right here. I hope I'm not on reverse tonight. Happy Money. Am I on reverse? Hopefully I'm not. Happy Money. It's a book by Elizabeth Dunn. And it's just a very simple book to learn. And it's probably a good one to gift to your kids or something like this. And it just talks about Elizabeth Dunn and Michael Norton, who wrote the book, are kind of like the world's leaders in how to use money to increase your happiness and these types of things. And you can see in here, I am reversed. Again, I am reversed. This darn software, I'm actually going to spin this around. Okay. So now, oops, as I knock the camera, am I reversed now? Please tell me. This is the book, Happy Money, The New Science of Smarter Spending. Hopefully I'm not reversed. I don't know why it does that every week, so I apologize, folks. But this is the quote that I pulled from this book. And they say, the whiteboard is reversed. It's actually a good thing if the whiteboard is reversed, because that's all my trade secrets up there, actually. That's all the secrets that I've got for how we invest at Rask. Not that bit, but this bit here. This is actually our investment process at a high level. So if it's reversed, it means you can't see it, which is probably good for me. Anyway, so over here, back to the quote from the book. So they talk about there's like 4 things. Everyone says that you should spend on experiences. When you spend money on experiences, you get something called a memory dividend. So it's the thought of remembering something actually brings you happiness. I'll give you a good example. They say that journaling is one of the key things that leads to more happiness in life, because it enables you to imagine something in the future. You cast your mind forward to a thought. Like, I journal at night and I'd say, I'm looking forward to my coffee tomorrow morning. That brings me happiness just thinking of the coffee, even though I don't have the coffee yet. But then when I go and I have the coffee, the experience tastes better because I've drooled beforehand. That's a principle. And then after the fact, going and having that coffee in an environment that brought me happiness actually pays memory dividends. So this is why they say to spend on experiences, not material products, which have the opposite effect. But it's not just good enough to just go and buy an experience. Like, hey, I'm going to go to Bali this week, or hey, I'm going to go to, I'm going to go climb the rock or something like that. There are 4 things that these researchers identified as ways to increase the bang for your buck when you spend on experiences. The experience should bring you together with other people for a sense of social interaction. The experience should make for a memorable story that you can enjoy retelling. The experience should be tightly linked to your sense of who you are. So it should be aligned with your personal values. And the experience provides a unique opportunity, eluding easy comparison with other available options. So there's the novelty factor, if many of you are familiar with that. So ultimately, these 4 things, if you're spending money in this way, according to these authors, Elizabeth Dunn and Michael Norton, these are 4 proven ways to increase your happiness from spending money. And this is why, if someone could tick all 4 of these points, I believe, and I truly believe this, there is no such thing as a guilty pleasure. If you want to go and eat Tim Tams with your friends, you might think it's $4 not well spent. I think it's great. there's no such thing as a guilty pleasure because it's something that you wanted to spend money on. You're doing it in the right way, and so on. And I think guilty pleasure is a phrase, kind of like buy low, sell high, is a phrase that has been made by people in the finance industry to make you feel like you should be doing something that you don't have to be doing. Like buy low, sell high. What a ridiculous saying that is. What about just buy low and buy again? I think that's what the next generation of investors will discover is the most important thing. Anyway, great book, Happy Money. There are 2 books called Happy Money. Turns out when you write a book, you don't own the title. So there's anyone can call their book Happy Money, and then there can be another book called Happy Money and another book called Happy Money. So this is the one that you want, Smiling Coin. That's the one you want. Oh, Jenny, you've asked a question about, is it possible to discuss QRI in the future? Yes, we definitely can. Maybe we'll get Drew on the show. Drew Meredith, that is. He's a specialist in all those types of things, so we can do it. Buy low, buy again. Owen's book title. That probably could be a pretty good book title, Rob. I've thought about writing a book, but it's just such a big effort. I have so much respect for everyone that writes a book because I know the effort that goes into it. Okay, guys, we'll be back next week. We'll be talking property most likely next week with Australia's #1 mortgage broker. Thank you, Rob from Self-Wealth, for jumping in the chat and telling us what's what over there in the Self-Wealth community. Thank you, everyone who did chime in tonight. There was a lot of good conversation back and forth. We'll be back next week. Probably not the same time. It might be during the day with Chris because he does have some young kids at home, so it would be good to get him during the day. But thank you so much, everyone. Thank you for contributing. Stay tuned. Don't forget the ASA tomorrow, Wattle Partners in Melbourne, NAOS in Sydney. I'm sure there's some other free events. If you do have a free event coming up, let me know and we can share it around, share the love, all that sort of stuff. All right. Thank you so much, everyone, for joining. Oh, one quick fact. Did you know the NASDAQ is up over 40% this year? Who would have thought that with all the negativity in the world, the stock market's still up 40%. Incredible stuff. I know. Tell me about it. There's a bit of good news for you. We can end it on that. Bye for now. I'll see you next time I'm looking at you.